Let's face it, managing money can be overwhelming. Whether you're trying to keep track of bills, figure out where to invest, or just make sure your savings are on point, it feels like there's always something to worry about. But what if I told you that AI could do a lot of that heavy lifting for you? Yep, we're talking about artificial intelligence. It's not just for robots in movies anymore. AI is everywhere now, and it's transforming personal finance in ways that are actually kind of mind-blowing. Imagine having a financial advisor who's available 24/7, never sleeps, and constantly monitors your investments, budgeting, and even your credit score without you lifting a finger. That's exactly what AI-powered tools are doing for millions of people. And the best part? You don't need to be some Wall Street guru to take advantage of it. From Robo-Advisors managing your stock portfolio to apps that automatically build you a budget based on your spending habits, AI is making managing money easier, smarter, and, let's be honest, way less stressful. But is it too good to be true? In this video, we're diving deep into how AI is changing the personal finance game, breaking down the tools that can help you save time and grow your wealth. Plus, we'll look at some potential downsides, because yeah, there are a few things you should watch out for. So if you're ready to see how tech can level up your financial game, stick around. Let's get into it. Section 1. AI-driven robo-advisors revolutionizing how we invest. If there's one area where AI is having a massive impact, it's in the realm of investing. Robo-advisors, the AI-driven platforms that manage your investment portfolios automatically, are a perfect example of how technology is democratizing access to financial management. In the past, managing investments was often reserved for high-net-worth individuals who could afford financial advisors. Today, platforms like Wealthfront, Betterment, and Ellevest are making professional-grade investment strategies available to everyone. And here's the kicker. These platforms are often cheaper, more efficient, and more accessible than traditional advisors. As Warren Buffett, one of the world's most famous investors, once said, "In the business world, the rearview mirror is always clearer than the windshield." This quote is a perfect analogy for what robo-advisors aim to fix. They remove emotional and hindsight biases from investing decisions by using data, algorithms, and historical trends to make smart, forward-looking investments for you. How do robo-advisors work? At their core, robo-advisors use complex algorithms and machine learning to tailor investment portfolios to an individual's specific goals, risk tolerance, and time horizon. It's as simple as answering a few questions when you sign up, and the platform does the rest. These platforms automatically balance your portfolio based on market conditions, and many even provide tax loss harvesting, which means they sell losing investments to offset capital gains taxes. A sophisticated strategy typically only available to wealthy investors with traditional advisors. For example, Betterment offers a goal-based investing approach. If you're saving for retirement, a home, or even a vacation, Betterment's AI tailors the investment portfolio accordingly. They also use modern portfolio theory, a strategy that optimizes the balance between risk and return. This is something human advisors might charge a premium for, but robo-advisors provide it as a standard feature. There are several advantages of robo-advisors. Cost efficiency. Robo-advisors generally charge lower fees compared to human advisors. Traditional financial advisors typically charge 1–2% of the assets they manage, while most robo-advisors charge as little as 0.25% to 0.50% annually. This can lead to significant savings over time, especially for long-term investors. Accessibility. Unlike traditional advisors who often require a minimum investment of $100,000 or more, robo-advisors typically have low minimums, sometimes as low as $1. This opens up investing to a much larger audience, including millennials and Gen Z investors who may be just starting to build their wealth. Emotion-free investing. AI doesn't have emotions, which is crucial when it comes to investing. Human investors are often prone to making emotional decisions, such as panic selling during market downturns or getting too greedy during booms. Robo-advisors stick to the plan, rebalancing your portfolio based on data, not emotion. This can lead to better long-term returns as they take the guesswork out of investing. Tax efficiency. One of the often overlooked benefits of robo-advisors is their ability to perform tax loss harvesting. This strategy involves selling underperforming investments to reduce your tax liability. For example, if your portfolio includes stocks that have lost value, the robo-advisor will automatically sell them and use the loss to offset any gains, helping you save on taxes. Customizability. While robo-advisors are primarily automated, many allow for some level of customization. For instance, if you want to emphasize socially responsible investing, platforms like Ellevest offer options to focus on companies with strong environmental, social, and governance metrics. While robo-advisors are impressive, they aren't without limitations. Robo-advisors rely heavily on historical data to make predictions about future market conditions. While they can rebalance portfolios quickly, they may not always be able to anticipate black swan events. rare and unpredictable occurrences that can cause massive market upheavals. AI-driven robo-advisors are transforming the world of investing by making it more accessible, cost-effective, and emotion-free. These platforms are ideal for those who want a hands-off approach to growing their wealth. While there are some limitations, particularly around the lack of human insight, the benefits of using robo-advisors for most investors far outweigh the drawbacks. As AI continues to evolve, we can expect these platforms to become even more sophisticated, offering more personalized financial management at a fraction of the cost of traditional advisors. So, are you ready to hand over your portfolio to a robot? Let me know in the comments. Section 2, AI-powered credit and loans, changing the game for borrowers. AI is also shaking up the credit and loan industry, making borrowing faster, more accessible, and more efficient than ever before. Traditionally, getting approved for a loan involved a lengthy process of paperwork and manual review. But with AI, the process has become highly automated, streamlining everything from credit scoring to loan approvals. Take platforms like Upstart and Kabbage, which use AI to assess creditworthiness. Instead of relying solely on traditional metrics like credit scores, these platforms analyze alternative data, including education, employment history, and even social media activity. This allows for more accurate assessments, especially for people who may have thin or non-existent credit files. For example, someone without a long credit history, but with stable employment, might be approved for a loan, thanks to AI's ability to consider a broader range of factors. The benefits are clear: faster approval times, more personalized loan offers, and in many cases, better interest rates for borrowers. AI can process applications almost instantly, enabling real-time decisions. Plus, AI can detect patterns in borrower behavior, reducing the risk of fraud and improving overall loan performance. However, it's not all sunshine and rainbows. Critics argue that AI-driven loan decisions can sometimes perpetuate bias. Since algorithms are trained on historical data, there's a risk of embedding existing inequalities into the system. For instance, if past data shows certain groups have been historically denied loans, the AI might unintentionally replicate these patterns. In summary, AI-powered credit and loans offer incredible opportunities for borrowers, particularly those underserved by traditional banking systems. But as with any technology, there are risks, and ensuring that AI systems remain transparent and fair is key to their long-term success. Section 3, AI in fraud detection and security, safeguarding your finances. One of the most critical ways AI is transforming personal finance is through fraud detection and security. In an increasingly digital world, where financial transactions happen with a tap or a swipe, the risk of fraud has also grown. Enter AI, which has become an essential tool for protecting consumers and institutions alike from fraudulent activities. AI's power in fraud detection lies in its ability to process and analyze vast amounts of data in real time. Take credit card fraud, for example. AI algorithms can monitor your spending habits and quickly identify any outliers, like an unexpected large purchase from a foreign country. Platforms like Visa and MasterCard use AI-powered systems that flag suspicious activity immediately, often before a fraudulent transaction is even completed. This allows for near-instant responses, blocking suspicious transactions before they affect your finances. One of the standout tools in this space is Plaid, which provides secure connections between financial institutions and apps like Venmo or Robinhood. Plaid's AI-driven security models analyze millions of transactions daily, identifying patterns that indicate fraud. AI systems like these learn from each transaction, constantly improving their ability to detect unusual activity. AI's ability to predict and prevent fraud. Unlike traditional systems that rely on preset rules, AI uses machine learning to constantly evolve. This means that the more data AI systems process, the better they get at identifying potential threats. Behavioral biometrics is another layer of security that's becoming more common. AI analyzes how you interact with your devices, your typing speed, touch pressure, and even how you swipe your screen. This unique data can be used to verify your identity, making it harder for fraudsters to impersonate you. AI also plays a role in spotting identity theft. Tools like Experience Hunter leverage AI to analyze application data and identify fraudulent behaviors, protecting users from becoming victims of identity theft. While AI is incredibly effective at detecting fraud, it's not without risks. One major concern is false positives, where legitimate transactions are flagged as fraudulent. This can frustrate users, especially if their accounts are frozen unexpectedly. Another issue is that fraudsters are also becoming more sophisticated, using AI themselves to bypass detection systems. It's a constant race between improving AI systems and evolving cyber threats. Conclusion. As we've seen, AI is changing the landscape of personal finance in ways that are nothing short of revolutionary. From robo-advisors that offer professional-grade investment strategies at a fraction of the cost, to AI-powered credit assessments that make borrowing more accessible, and fraud detection systems that protect our financial data, AI is helping us manage our money smarter and safer. These tools are removing many of the barriers that once made personal finance complex and intimidating, making it easier for everyone, whether you're a seasoned investor or just starting out. But like any powerful technology, AI comes with its own set of challenges. While it can automate and optimize financial processes, it's important to remain aware of potential risks, such as bias in AI algorithms or false positives in fraud detection. The key is to use these tools as complements to your financial management, staying informed and engaged in the process. So what do you think? Are you ready to leverage AI to take your financial game to the next level? Let me know your thoughts in the comments, and don't forget to subscribe for more insights on personal finance and the latest tech trends. If you found this video helpful, give it a thumbs up and share it with others who might benefit from these AI-driven tools. Keep working towards your financial goals and be kind to the others. I'll see you in the next one.